Welcome back to Be Rich. After Namakkal, my team decided to do an event in Vellore. We have familial connections with Vellore. My father went to college in Vellore. He attended the Wooders College. So we are doing an event in Vellore on the 20th and 21st of July. Those desirous of attending this event should contact the WhatsApp number given below and send a message to the Gmail ID that is also given. Try to call as early as possible to avoid rush and disappointment. Because in Namakkal, we had to decline a lot of people who wanted to attend the event. Once again, I thank you for supporting Be Rich. Good evening and welcome back to Be Rich. So, Sashwath has brought a very interesting topic for us to discuss today. And that's something I do every day. Allocate capital. One is you have a pool of capital, money comes in from various sources. Where do you want to invest your money or where do you want to allocate capital to? Whether you want to buy an equity, then you are putting money into a business. Whether you and then which equity to buy and whom to give you that capital to is one. Second, whether I want to buy a bond or whether I want to buy a money market instrument for the short term. Whether do I want to buy gold or whether I want to keep it in the bank. These are the range of options open to me, and these are decisions I make every day. Buffett is one of the greatest capital allocator of all times. Now there are two elements to this. One is that I allocate capital as an investor. Second, how efficient or how smart is the company that is taking capital from me and how smart is it at allocating capital. These are two facets of the game. One of the my favorite groups, which most of you will recognize, is the House of Tatas. I talk about them, about ethics, their values, their commitment, the way they treat their employees, the way they treat their clients. But one thing Tatas are terrible at is allocating capital. They can keep pouring money and pouring money even in lost causes. Like the amount of money they have poured into chorus, and still there is no light at the end of the tunnel. But they can pour a lot of money and turn businesses around, which they could have cut their losses. Passenger cars is an example by which they could have cut their losses. So they're terrible allocators of money. In fact, my friend Anish Gupta has been saying, if TCS did not have to fund Tata groups, by now it would have swallowed Infosys and CTS and become a big giant Indian IT company. But the Tatas being what it is, they needed the money and they took the money and decided to invest in steel and Tata Motors. And right now they are buying Air India, which again I would financially consider a bad allocation of capital, though they are emotional and sentimental about the company. So let us understand what Sashwath is talking about and let us understand what is the importance of allocating capital, both at the level of an investor and then at the level of the company at which you have invested. Over to you, Sashwath.
Right. So there's this quote by Yogi Berra, who's a famous baseball player. He has won many awards. He's one of the greatest catchers baseball has ever seen, and he's famous for his quips. And the quip which I'm going to talk about today is: in theory, there is no difference between theory and practice. In practice, there is. This is the quote by Yogi Berra. Again, I'm taking the.
So, what does he mean by that?
Right. So he means that in theory, there should be no difference between what you learn in theory and what is actually happening in the real world. However, if you go to the real world, you'll see that there definitely is
There's a difference between what you learned in theory
and what is happening.
It won't work.
Yes.
In economics, I'll tell you one quick quip.
Yeah.
The rational human being does not exist in reality.
Yes.
Now the pendulum has swung the other way. The behavioral guys have gone overboard and trying to fiddle with the results to match their expectations.
Yeah.
Both are wrong. There is no rational human being. No, but humans are 90% rational and only 10% irrational.
Yes.
The irrational, the behavior science guys would like you to believe they are 90% irrational and 10% rational.
Yeah.
That's not true. At most times we are rational, but about 10% of the time we behave irrationally.
Yes. So getting back on topic, a lot of business executives today are operationally skilled but lacking capital allocators. Capital allocation, it seems, has become a tool for obfuscating the true economics of a business. Basically, to shroud the true economics of a business, capital allocation has become a tool to hide and deceive rather than a tool which is supposed to augment your company's intrinsic value. This article is a 2015 article from The Rational Walk, who we also discussed previously. So he gives the example in 2015, November 16th, the Monday. He says Wall Street Journal has an article on the front page which says that energy companies have doubled down on their promise to protect dividends despite drop in profits due to lower oil prices. And this article is inspired by that. He says that these companies have increased dividends year over year for decades, regardless of what happens to their profits and their earnings. This, to an intelligent investor, doesn't make any sense. To someone like Warren Buffett, this would make no sense at all. Why would you pay the same dividend or even increase the dividend when clearly your profits are taking a hit? What if you're not able to make up your capital expenditure? Why are you still paying a dividend? We've looked at companies which are borrowing to pay dividends.
I want to make one addition there.
Yeah.
One of my favorite companies, which went down the tube and I'm now buying it in the tube, is Intel. Intel fell victim to the same policy. And because the great man felt that there should be professional management when he quit, and he quit and he died of prostate cancer. The people who followed Andy Grove were not as committed to research and killing processes the way he was. And they were more interested in making investors happy. So a lot of talent left Intel. Intel had a license to manufacture ARM, and they could have made this low power processors which everybody is talking and Intel is not able to make, they could make. And today AMD is beating the shit out of Intel in market cap is only because Intel's managing directors and chief executives were busy doing chief financial engineering and borrowing to pay dividend rather than concentrating on R&D and building next generation of chips. A great company which created the computer revolution because it didn't have a strong owner like Bill Gates. Bill Gates was much younger. Andy Grove did not have a good successor. Bill Gates was succeeded by Steve Ballmer, and who's now succeeded by Satyam Nadella. They were all committed and the company really took off.
Yes.
Intel on the side did this succumb to this idea of borrowing money to pay dividends and got screwed badly. Intel is down and out for the count. Your old hand at Intel has come back to run it. We are just hoping that he will turn around Intel. Anyway, over to you.
Hey guys, I'm going to quickly interrupt this video to announce that we have successfully launched our Substack, where we talk about companies, US markets, European markets, and Japan as well. And these insights are going to be delivered straight to you to your email as well as the Substack app. We hope you go check it out. The link is moatinvesting.substack.com. The link will be on the screen right here and also in the description. Thank you for checking it out. Yeah. So they're not acting as skilled capital allocators. They're paying a dividend to the detriment of your company, and it does not make any sense. Capital should be allocated to augment intrinsic value and not to appease the short-term interests of certain shareholders. Suppose you're buying these oil companies for long-term dividend payments. You'd rather have the company do well and pay you more dividends later on than taking short-term dividends when they're not able to pay out these dividends. And he says that if the future can be foreseen perfectly, which it cannot, but let us go into the world of theory, and if the future can be foreseen perfectly, intrinsic value of any firm rests on the free cash flow that the firm is able to generate in the upcoming years, discounted back at the appropriate rate of return which you see fit. So the firm can use this free cash flow being all the earnings which is left after all the costs which are accounted, as well as all the capital expenditure which is needed to sustain the business at the current level it is. This is the excess money which now they have a choice to allocate the way they want. So these are the possible ways in which they can use free cash flow. 1. Invest in internal expansion opportunities. Expand to gain a deeper competitive advantage. This could possibly be greater R&D. This could be opening up more chains to corner more of the market. There are many ways in which internal expansion can go about. This is basically to widen your company's moat, which automatically does augment your intrinsic value. 2. You get to invest in external expansion or diversification. Acquire external firms to consolidate market share. So it's basically as if Facebook buying Instagram and other social media platforms to gain more of the market share in social media and the internet. And you capture synergies. So you do either forward integration or backward integration, where you capture more portions of the value chain. And the resulting enterprise is more valuable in a conglomerate rather than each entity sold separately. This is the idea behind external expansion. And conglomerate structures could also be pursued by a skilled capital allocator, for example, Berkshire Hathaway, where Warren Buffett, who does not engage in operational efficiency, rather he only focuses on capital allocation, where he has a whole host of businesses which aren't very interrelated at all. So he has insurance, he produces batteries, he makes ice creams. Only it's very hard to figure out what batteries and ice cream have to do with each other. But Berkshire Hathaway has made it work and they've delivered excellent returns. So the last two options are: one, you pay down debt. A firm can choose to deploy the free cash flow towards changing the capital structure by reducing debt. So suppose the business is running heavily on debt. Suppose you have a lot of free cash flow, you don't have internal expansion opportunities or diversifying opportunities, then you can choose to pay down the debt in your company during good times in order to make your company be more resilient to financial shocks. And sometimes it's good to carry debt for tax efficiency. This is also something which the author talks about. What do you think about this so far?
Well, I think this is great in the sense that Intel stumbled on this.
Yeah.
But sometimes what happens is they borrow to pay capital. Like in Tata Steel, they borrowed to buy Chorus.
Yes.
And they kept on raising equity over years. I know I have subscribed to those shares. And of course, it's a great company.
Well, just one point on the Tata thing, because you brought up a good point. What the rational work also talks about is that cyclical companies like Tata Steel, when they're unable to make acquisitions which are otherwise good during bad times during their cycle, they end up borrowing during those times, reasoning that during good times they'll be able to pay down the debt using their free cash flow.
They are struggling to repay debt. They had 1 or 2 good years and they have managed to bring it under control.
Yes.
But they are not talking about being zero debt anytime soon. And so what I'm trying to say is, they are poor capital allocators. They bet on cars. It drained a lot of money. It was a great commercial vehicle company. He kept betting on cars and he has now finally arrived. He has now got a stake, but it has took 10 or 15 years.
He's doing quite well now.
No, yeah. But I was lucky enough to watch it and come at the bottommost point.
Yes.
But imagine somebody who had Tata Motors at 500 rupees and then it goes down all the way to 70 rupees and then has now gone to 1000 rupees. So these kind of poor capital allocation decisions makes it swing wildly.
Yeah.
Tanishq was making losses for some time till Bhaskar Bhatt turned it round. And what was a 3 rupee stock has now become a 3000 rupee stock. They are ruthlessly efficient.
Yes.
They know how to make correct bets, but they are poor capital allocators, which gives you times to enter at the very low prices.
Now, let's move on to the final way in which free cash flow can be used: return capital to shareholders. If internal and external buying opportunities are scarce and the level of debt is in its optimal position, then the firm can return capital back to shareholders in two ways. One, dividends. The first way in which a firm can return back capital which is better used in the hands of the shareholder. So the problem with this method is that the expectations are set, and once a firm decides to pull back the dividend, they are unable to, because shareholders feel like the rug is being pulled off right from underneath them. And like the petroleum stocks, what ends up happening is that they punish the market price. And even if the firm wants to make an acquisition later on, which is a brilliant acquisition, they will be unable to because their stock prices are too low. And even those CEOs who are at the top positions of these companies, their stock options are based on the stock price. And if the shareholders punish the company for pulling back dividends, the stock options also get affected, and there's a huge bias for these top level managers to pay higher dividends to keep the stock price up. Second point is that they can do stock repurchases. This is something Berkshire Hathaway has done, Intel has done, it's something which Unilever has done, and even Apple has done. So stock repurchases are another way in which companies are able to give back capital to its shareholders, because without doing anything, the shareholder now controls a larger portion of the company. And if the stock is trading at well below a conservative estimate of intrinsic value, like Berkshire Hathaway was for quite a while before 2021, they end up buying these stocks and then extinguishing it. And this creates value as no taxes are paid for the shareholder to receive this increase in their portion of capital. And this is comparatively to dividends. If this is possible, this is an even better option. Sometimes this can be manipulated to get stock options valued more, because by extinguishing more shares, the book value goes up and therefore price also goes up generally. But all in all speaking, it does benefit the shareholder at the end, and it's a way to channel this free cash flow back. These are the ways in which a company can use free cash flow. And now the question then becomes, For a strong firm, it may make sense to engineer major acquisitions in times of business weakness by using either debt or common stocks, especially when shares are not undervalued. However, it's imperative to make a right judgment call because, like Tata Steel's example, you may end up with a tumor on your company, which even during good times you're not completely able to pay off the debt which you borrowed during the bad times. And moreover, it's questionable that these companies continue to pay large dividend yields when they're unable to during times of weak free cash flow. And this is something we made a video on before, and it's a question. You have to question why companies are paying a high dividend yield.
No. I asked one of our executives, asked Tata Steel the same question. Damn it, you are borrowing more.
Yes.
You are increasing borrowing. Why are you paying dividends?
Yeah.
There's no need to pay dividends.
Yes.
Bring it down, man. So he said, no, it is company policy. We've always paid dividends.
That makes no sense. And this is exactly the irrationality in capital allocation which we are talking about here, because it makes no sense to pay out dividends when when you're better off using that capital to either make your financial position stronger or acquire other companies. Or suppose you're in a situation where you're not able to meet your capital expenditure, it makes no sense in artificially suppressing your capital expenditure and putting your business in harm's way. This is the article which I wanted to discuss today. What are your closing thoughts on this?
Yes, capital allocation is very important. Buffett is a genius at it, and he's got most things right. Of course, he had Charlie Munger to tell him when he was doing stupid things. And like I said, my favorite group is very poor at capital allocation, and it destroys a lot of value for investors over long periods of time. So it so happens in Tata Steel, I had the stock. I went it down. It went down and it went up. In case of Tata Motors and in case of Tata Consumer, I could buy at the lowest point. Thank you for watching, Be Rich. I hope you like this presentation. If you did, please like the video and subscribe to our channel. If possible, send this video to your friends and relatives and have them take a look. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.